Ray Dalio isn't just the founder of Bridgewater Associates. He's the architect of an entire philosophy.
Money, credit, debt, economic cycle in which there's a building up of debt in a cyclical
that
way.
Rewrote the rules of modern finance. While most investors try to hide their mistakes, Ray leans into them. To him, every failure holds the seed of future improvement. He analyzes what went wrong, extracts the lesson, and uses it to fuel his evolution.
Reality is reality. A lot of people say they want to fight what reality is. Stop thinking about it being differently. Just understand, like, why did that thing happen to me? And how do I put it in perspective?
And this mindset isn't just motivational fluff. It's the foundation of results that speak for themselves. Bridgewater isn't just the largest hedge fund in the world. It's also the most profitable one in history, returning over $50 billion to its investors. That's not luck. That's the result of a system built to get smarter with every misstep. What's truly remarkable about Bridgewater isn't just its returns. It's how precisely it has handled enormous amounts of capital over decades. From the beginning, Ray Dalio chose a different path. While most hedge funds relied on traditional technical models, he combined macroeconomic fundamentals with algorithms, creating a hybrid approach that few dared to try at the time, but it worked. And it reshaped the financial industry. Dalio's flagship fund, Pure Alpha, wasn't designed to follow the market. It was designed to think independently. He makes a sharp distinction between beta and alpha. A beta is the return anyone can earn just by riding the market. Alpha is different. It comes from insight, discipline, and precision. That's why Dalio has openly criticized funds that charge high fees while delivering little more than beta returns dressed up as alpha. Bridgewater's Pure Alpha has near zero correlation with traditional markets. In simple terms, whether the market goes up or down, its returns come from process, not prediction. And they've proven that consistency over decades. Dalio also created another cornerstone fund, All Weather. Its mission was simple: build a portfolio that could thrive in any economic environment. To do that, he developed a mental model built on two key forces: growth and inflation, each of which can either rise or fall. That creates four possible economic climates. From there, he designed portfolios not based on asset classes, but based on how different assets behave under each scenario. He extended this same logic to the global stage, classifying countries not only by whether they're debtors or creditors, but by whether they control their own monetary policy. The result? A conceptual map of four economic archetypes, each with its own strengths and vulnerabilities. But what truly sets Ray Dalio apart isn't just his investment strategy, it's his personal philosophy. He holds an almost spiritual belief that failure is necessary for success. Every mistake is a teacher. Every misstep is a doorway to stronger principles. At Bridgewater, mistakes aren't punished unless they're hidden. Meetings are recorded, tough feedback is encouraged, criticism isn't personal, it's essential. That's the core of what Dalio calls radical transparency. He doesn't expect perfection, he expects growth. He knows that everyone, including himself, will make mistakes. The real question is, what do you do after you mess up? The ones who reflect, learn, and adapt will thrive. The ones who deflect, deny, or blame stay stuck. For Dalio, the ability to be wrong without losing direction is a competitive advantage. If you don't mind being wrong while moving toward what's right, you'll grow fast. That's how Ray Dalio sums it up. He placed his first trade when he was just 12 years old, not for profit, but out of pure curiosity. To him, the markets were a living puzzle, an infinite game. The thrill wasn't in making money, but in figuring out how the machine worked. He wasn't chasing financial goals, he was chasing fascination. And that mindset shaped everything that came after. Learning to think like an investor from a young age gave him a worldview completely different from the one taught in school. In the classroom, you're rewarded for memorizing and getting the right answer. But in markets, uncertainty is constant, and adaptability is everything. Over time, Ray Dalio developed a deep respect for what he didn't know. Before making decisions, he would challenge his own thinking, asking others not for validation, but to find what he was missing. What others saw as vulnerability, he saw as strength. To be an independent thinker means living with the risk of being wrong, but also having the discipline to stress test every idea before taking action. His first real exposure to the markets came in the 1960s, when stock talk was everywhere, even at the barbershop. He worked as a golf caddy, overhearing wealthy clients chat about investments between swings. That environment didn't just inspire him, it hardwired a way of thinking. He learned that clarity matters more than comfort, that truth beats ego, and that real learning never stops. He remembers his first investment clearly. He bought shares of Northeast Airlines just because they were under $5, so he could afford more of them. There was no research behind it, just a hunch. But he got lucky. The airline on the brink of collapse got acquired and he tripled his money. That early win convinced him investing was easy until his first bear market hit at age 18. That's when he discovered short selling. Later in college, he dove into commodities, fascinated by how small amounts of money could control massive positions. Leverage wasn't just powerful, it was thrilling. One of the most pivotal moments in his career came in 1971. Dalio was working on the floor of the New York Stock Exchange when President Nixon took the US off the gold standard, severing the dollar's link to gold overnight. Dalio expected chaos, a market crash, but instead, prices surged. That was the moment he realized. When governments print money, asset prices can go up fast. But the deeper lesson, you can't blindly trust what politicians or central authorities say. Because what moves markets isn't always what's said publicly. It's what happens behind closed doors. In 1982, he watched the same dynamic play out again. The US economy was struggling. Unemployment was high. Countries like Mexico were defaulting on their debt. Everyone expected a financial meltdown. But the market rallied, kicking off nearly 2 decades of growth. What changed the outcome? The Federal Reserve stepped in with aggressive policy. Dalio learned something critical. It's not the crisis itself that matters. It's how the people in power respond to it. From that point on, he stopped focusing solely on bad news. Instead, he watched the people who could actually change the outcome. For Ray Dalio, real learning doesn't happen in abstract theory. It happens in the body, in the nerves, in the moments that sting. One of his most painful lessons came in the 1970s when he made a big bet on pork futures using his own money. The price dropped, then it dropped again. Day after day, the market hit its limit-down circuit breaker. That sound, the buzzer, became a physical reminder of fear and failure. That experience taught him a rule he never forgot. Risk must be controlled. No trade, no matter how promising, should have the power to destroy you. In the world of money, you need to be bold enough to win, but cautious enough to survive. Dalio compares trading to handling electricity. Powerful, but dangerous. If you're careless, even once, it can burn you. Over time, Ray Dalio discovered what he calls the holy grail of investing, and the principle behind it is surprisingly simple. If you build a portfolio made up of assets that don't move in the same direction, you can dramatically reduce risk without sacrificing returns. Let's say all your investments react the same way to the same event. That's not real diversification. But if you combine assets that respond differently, some go up while others go down, your portfolio becomes more stable and your volatility drops. Dalio says that with just 15 truly uncorrelated return streams, you can cut your risk by as much as 80%. That insight pushed him to design portfolios with over 100 different return drivers, all selected not by surface-level patterns, but by understanding the real reasons behind each asset's behavior. Dalio is very clear about this. Correlation isn't some invisible force that binds markets together. It's just the result of shared underlying drivers. For example, when economic growth changes, stocks and bonds might move in opposite directions. But when inflation shifts, they might suddenly move together. That's why relying only on correlation numbers can be misleading. The key is to understand why each asset moves the way it does. If you understand the true cause and effect behind an asset, you can combine it with others in a way that's not just mathematically sound, but logically smart. Inside Bridgewater, the culture is demanding and refreshingly honest. Truth comes before ego. People are expected to think for themselves, to speak up. There's no tolerance for lies, for spin, or for protecting fragile opinions. Everything is recorded. Everything is open, and everything is up for debate. Dalio believes one of the biggest problems in the world is this. People are far too certain about things that simply aren't true. They say, "I believe this," or "I believe that," without ever seriously listening to an opposing view. He says that if people were a little less stubborn and a little more curious, the world would make far better decisions. That belief is what shaped Bridgewater's culture, a place where being right matters less than searching for what's true, where mistakes are seen as opportunities, and where real learning starts when you accept that you might be wrong and choose to grow anyway. When disagreements arise, even between Dalio and other top leaders, the goal isn't to win the argument, it's to dig deeper together. Why do you think that? What evidence supports it? What should we investigate as a team? That question-driven approach leads to discovery, and discovery is the foundation of deep learning. If the disagreement could impact Bridgewater's core investment system, all three chief decision-makers must be in full agreement. If there's no consensus, nothing changes. It's not about being right as an individual, it's about reaching collective clarity. They don't make emotional trades, they establish principles, program them into models, and stress test them against decades of global history. It doesn't matter if it's Japan in the 1990s or the US in the 1930s. The logic must hold in any era, any economy, anywhere. Dalio warns that many strategies fail because they're built on what's happened recently. And that might work for a while, until the environment shifts and everything breaks. That's why he favors universal, timeless strategies. Approaches that work in any country, any decade. For decades, Bridgewater has studied how and why each strategy performs, when it wins, when it fails, and what causes both outcomes. If something underperforms, they don't ignore it, they break it down. And if they find something useful, they refine the system. That constant evolution is a big part of why Bridgewater has only experienced 2 major drawdowns in over 20 years. And the worst was just 20%. That kind of resilience isn't luck. It's the result of deep diversification and rigorous testing under extreme conditions. At Bridgewater, they don't use automatic stop losses. A losing position isn't closed just because it's in the red. What matters is whether the idea behind it still makes sense based on the data. A drop in price doesn't mean the thesis is broken. They only re-evaluate if the rules no longer support the trade. Losses themselves aren't the trigger, but the lessons they leave behind, those are. Back in 1994, their models said to buy bonds. The trade lost money, but instead of abandoning the strategy, they looked for a better way to apply it, and discovered that by comparing relative markets, they could improve their risk-adjusted returns. That failure led to a better model. At Bridgewater, rules only change when the logic improves, not because someone feels differently. Every update goes through the system. New information is analyzed. If it adds value, it's added to the model. Personal opinion doesn't guide decisions. Logic does. Only in rare cases, like extreme events such as a terrorist attack, can risk managers intervene manually. But that happens less than 1% of the time. Nearly every decision at Bridgewater is made without emotion. And despite being one of the most successful systematic funds in history, Bridgewater doesn't use technical analysis. No chart patterns, no price-based indicators. Every move is grounded in real-world fundamentals. Economic growth, inflation, monetary policy, global trade, and other macroeconomic forces. The process is automated, but the principles behind it are deeply human. The system wasn't born from luck. It started with a notebook. Every time Ray Dalio placed a trade, he'd write down why. Later, he'd compare what he expected with what actually happened. He realized that learning only from personal experience was too slow, so he turned to history, testing his rules against decades of data. That's how the system began. Over time, his team helped refine it, but the core never changed. Clear thinking, tested with real evidence. Rules evolve, because when the world changes, the logic has to evolve too. When the UK shifted from being an oil importer to an exporter in the 1970s, Bridgewater adjusted the way they interpreted oil price movements. That kind of flexibility is what allows them to manage enormous capital without sacrificing performance. Two key differences set Bridgewater apart. First, they trade in nearly every liquid market on the planet, so only a small portion of capital is allocated to any single one. Second, they move slowly. While most funds chase short-term moves, Bridgewater enters and exits with discipline and patience. The larger and faster you trade, the more it costs. Their slower pace is a strategic advantage. On average, they rotate core positions every 12 to 18 months. Even during the 2008 crisis, they didn't speed up. Their system isn't built for drama, it's built for logic. If prices fall but the fundamentals stay strong, they buy. If prices rise without justification, they sell. That often puts them on the opposite side of public emotion. They never let a position grow so large that they can't exit it smoothly. If liquidity risk increases, they scale down. And even though their fund has been closed to new investors for years, when assets grow too large, they return capital to clients. Because the goal isn't growth for its own sake, it's sustainability. And the principle never changes. Think clearly. Act with discipline. Review everything. Not to predict the future, but to be ready for it. In 2008, when the financial world was unraveling, Bridgewater was already prepared. Not because of magic, but because they had spent decades studying economic collapses. Germany in the 1920s, Latin America in the 1980s, Japan in the 1990s, the Great Depression. They had even built an internal tool, a depression index, designed to detect warning signs. Things like falling credit, market declines, rising debt costs. So when the global crisis hit, they didn't just survive, they thrived. In the end, the story of Ray Dalio and Bridgewater isn't just about profit, it's about a relentless pursuit to understand how the world works, to learn from failure, and to turn setbacks into strength. Dalio's legacy isn't just measured in returns, it's a mindset, a system, and a philosophy of life and work that has inspired generations of investors and thinkers around the world.